And Tuesday brought us a new month and a new trading pattern. Apparently the last couple days, a lot of the sellers were the result of closing out monthly positions. So this morning, some of the buyers are back. The German Bund, still fun to say, was actually outpacing treasuries, which rarely happens. This retracted a bit as domestic trading started, then got worse with ISM data as it came in. The S&P ISM Manufacturing Index came in at 50.02 on a 50.0 estimate, pretty close. But that is down from 50.9 previously. This is the lowest level of factory activity since May of 2020. A measure of prices decreases from 51.7 to 46.6. So in order to keep up even this pace, they're having to lower prices. Small beat, but bonds were selling as a result of it. Global stocks rallied on speculation that China may phase out its stringent COVID-0 policy fueled by risk-on sentiment. U.S. listed Chinese stocks soared in pre-market trading, tracking a strong rally in the Chinese markets. CoreLogic came out with its home price index, which came in at minus 0.5% in September, for 11.4% year over year. Still very high, but down from 13.5, but down from 13.5 last time. The JOLTS, which is the job openings and labor turnover report, showed 10.7 million job openings for the month, up from 10.3 million in August. Though a bunch were double counted, this is a kind of flawed statistic because people working from home can lead to double counting. At the end of the day, we are up 6 basis points, ending up at 98.81, which puts us just under that 25-day moving average, which has served as our ceiling. We have broken through it several times over the last couple days, but it just won't hold. So hopefully we can get through that and set a new range. Also got an interesting piece of information here. The government is beginning to worry about liquidity in the treasury market. One of the problems with borrowing a lot of money is that you need to continue to attract a lot of money in order to roll over the maturing debt. The fear is that we could get some failed auctions. Part of this being driven by events in the UK where yields on the UK gilt, which is the British version of the Treasury, spiked some 120 basis points over the course of a few days. The root of the buyer's strike is due to a lot of things, but ultimate reason is nothing more than price and value. With inflation running at anywhere between 5 and 6%, a 10-year Treasury paying 4% isn't an attractive investment, because basically your income is not going up at the same pace as inflation. Global central banks have engineered a bubble in sovereign debt, which is something I don't think we've seen before. Central banks in general have only been around for about a century, so this is all new territory. Note that the Fed is now paying more interest than it receives in income from its Treasury and MBS portfolio. The Fed pays all of its profit to the Treasury, and now that is running losses. It is accumulating an IOU. When the Fed starts earning profits again, those profits will pay off the IOU, but we don't know exactly when that's going to be, and that number is going to get big. The Fed also does not mark its portfolio to market, which is good news because it'd probably be a few $100 billion underwater on its MBS portfolio, which would put pressure on them to sell that and really wreck our rates. And we got another post from our sponsor at WellThatMakesSense.com, another great post from the exceptional book Persuasion by Robert Cialdini. There is a certain type of unity of identity that best characterizes a we relationship, and that, if persuasively raised to consciousness, leads to more acceptance. So this is great insight about how you can align yourself with your customers before actually trying to persuade them to be more influential. Check it out at www.wellthatmakessense.com.